Maurice, simple question first, right off the bat. Hey, Mike, I want to look at buying calls, but I don't know which strategy to use. Can you help? Yes, Maurice. If you're looking to buy calls, the strategy on Power Options you want to use, we call it a long call. Buying a call, buying a put is long call or long put. Selling a call or selling a put is the naked call or the naked put. Our approach in general, we tend to follow the default settings here for buying calls in the search, Maurice. I'll just make sure my screen's going up. There we go. Using the, I tend to use the Bollinger Band's default screen. We're looking for stocks that are close to or looking to break out of their upper Bollinger Band. Usually see a small retracement after that, but then the stocks continue to extend upwards. Of course, you can put in your own criteria any way you want to. Ernie and I do not recommend doing shorter term long calls unless you're speculating and you really think the stock's going to move quickly in a 4 or 5 day period. We prefer to go 60, 75 days out of time minimum to give the stock more time to move in our direction. Akin to what Sam might say he's doing 30, 45, 60 days out on the long strangles and straddles. He's starting off with SPY and then managing them shorter term with other selling to close, rolling, adjusting, or maybe selling the puts as well. Okay, so that's generally the approach that I use. Now, a common question that comes in while we're here, Maurice didn't ask this question, but we're under long calls, we're in the search. But a question always comes in, hey, is it better to buy an in the money, an at the money, or an out of the money call? Well, the answer is it depends on your expectation of the movement of the stock. Okay, there's no one general answer. There kind of is. What do I mean by that? Well, we have this nifty tool called the Long Option Finder for calls and for puts. We use Apple since we spent some time on Apple earlier with that reversal position. We know it's around $500, $502. So let's say I'm expecting a 5% move on Apple. I expect it to move up to 525, right? That'd be roughly a 5-point move, 527. And I know I'm going to have to put in a high amount of capital, so let's call it $4,000. And I expect this to happen within the next 20 to 30 days. So let's just go to standard September expiration. Okay. Now, what this tool does is it's going out right now, Maurice, and it's going across the entire chain for Apple, which is pretty big. I should have chosen a smaller stock for this example, but it's okay. And it's calculating what option would give us the best return if Apple did move up 5% or to 525 in the next 18 to 20 days. And we see that the in the money September 480 call with a price of $37.65. Now, this is also tricky because I only used $4,000. So I can only afford these options. Any of the options that are priced at $50 or $60, I likely couldn't buy right now. I should put $10,000 in. Let's do that. It's going to give me a little bit different numbers. But anyway, I want to just use it as a quick illustration, which is not that quick because of the chainsaws of Apple and the fact we're probably uploading the history right now at the same time. In any case, so we got our rules now. Still about a 29% return, but now good. It's the 450 call, which is deep in the money. It's about 10% in the money with our stock at 502. Oh, it ended at 499.23. Let's just call it 500, okay? So this, with a 5% move, the deep in the money call is giving us the better return. Why am I not seeing the 500? Because it would be at a loss. Why am I not seeing, if I expect the stock to go to 525, why am I not seeing the 510? Because it would probably cost $20. And if the stock's trading at 525 near September expiration, that low price near-term September call for $15, right? Well, whatever it is, $20 right now would only be worth $15. We'd be at a loss. Now, what if we expect more than a 10% movement? We expect it to go up to 560 in the next 20 to 28 days. We'll keep our cost at $10,000 in this case. Okay, I'm just going to run through for, sorry. There we go. Now you're seeing the out of the money options and you're seeing a higher return. Okay, so what is the best call to buy? Well, if you're expecting a 10, 15% move, the out of the money is probably better. If you're expecting only a 5 or 7% move, the in the money is probably going to be better because there's a chance that out of the money will expire worthless and not give you the full profit. This tool will help you with that. Okay, the long option finder, you can find it under the long call or the long put tab. And if I put the, a 10 or 15% decline, of course, down to 450, it would show me the put options. It doesn't matter that I link to this tool under the long call. If I put in a lower price, it'll automatically show me the puts that would give me the highest theoretical return. Okay, so Maurice, that's what I look for with the long calls. I tend to use the Bollinger Band search that comes up on PowerOptions if I'm buying new calls or speculating in that direction, and use the long option finder if you're looking at a specific stock and you have a specific target in mind to help quickly show you which option would give you the best bang for your buck, the highest return if the stock does hit near or hit your target price on your expected target date. Fantastic. Let's go back. And let's get to our next question. Real quick, though, Sam had just wanted to comment is that he's currently he's looking at SPY at a 350 straddle. It's pricey at 39.28 and expires in January 15. Oh, I'm sorry. He's in a 350 straddle that's pricey. More upside limited, but the puts will be rewarding if we have a drastic surge in COVID or the market goes bearish. Kind of thinking about as we mentioned with that, oh, you're not in the trade, Sam, my apologies. You're looking at the 350. Excellent. Okay, but along those lines, of course, seeing the sell warnings on the market sentiment tool, of course, that have been recently. We've got a question related to that in a moment. Expecting maybe a 5 to 10% correction as is after this long run. Okay. What have we got next? We did this, we reviewed this a little bit a couple weeks ago, I believe, for Fernando, Eric. Eric says, how or why would you do gamma scalping? I personally don't. Okay, it's not a trade I do. The idea to me personally of delta scalping, vega scalping, gamma scalping, hedging, delta, gamma, theta hedging, and so forth means you're constantly adjusting positions to stay within a specific range, Eric, of a need to be near a zero delta or to be near a zero gamma. And I just don't have the time for it. I don't have the patience or the time to consistently roll, have a position open where maybe sold 5 calls, bought 4 calls, have 3 naked puts, and then have to adjust 2 of the naked puts and 1 of the calls, and then create another debit spread so I'm not naked anywhere to fit this gamma hedge or the theta hedge. Now, Fernando had mentioned earlier that a lot of people, I think, or a lot of investors I see talking about it, they'll look at a long straddle position. There's NTNX, as you mentioned. WPR isn't there, as you mentioned, Sam, but there is NTNX. My apologies. So what do we know here? What is gamma? Okay, well, gamma is the expectation that we have that how is essentially the delta going to change, right? That's what we're looking at. So the gamma there, we're kind of expecting on what is the change in delta and how can I hedge that if I'm long and short different positions. And Fernando mentioned that a lot of people do with the long straddle is they'll use the stock, Eric, as a way to hedge gamma. Not necessarily vega, but they'll use it to hedge gamma in that case by buying the stock to sort of counter the delta and counter. Or they might go short stock inside of the long straddle to do a gamma scalping position or a gamma hedge position in that case. Okay, so based on if the stock moves up or down, you're in the straddle position, as Fernando mentioned, you're looking to sort of hedge the gamma, then you do it in that case. Now, Fernando offers, I don't know how he does it, exactly what he means by this. Fernando says he does a lot of adjustments with the gamma scalping. They're very consistent, and he uses an automatic system. Now, Fernando's out in Italy, and so I don't know exactly what system he's using, what trade, if it's at his broker, if it's at somewhere else, his own system that he created to do that. It is labor intensive, Eric, but it is involved with being straddles and strangles and going long and short stock based on how the position is moving. If it's moving down, the gamma is being effective, I believe, negatively to you. So you want to correct that with possibly going short stock and then going long stock. Or, as Fernando mentioned, you've got multiple contracts of the call and put. You're rolling half of them to a new strike. You're rolling them up or down depending on how the gamma is being affected by the movement in the underlying positions. Okay. Mike has a quick question on the tools. There's not a way to do that right now. After the final updates are made to the portfolio tool, you will see something along those lines. I don't have a large portfolio here, but you can see Mike's basic question. Mike E had a question last week too about the columns, but he says, how can I fix the column headers in the portfolio so when I'm scrolling down, I can still see them? Well, there's not a selection to do that right now. You heard me mention that we're making some changes in the background to the different graphs to remove some of the older graphs. You saw the new graph there that was added for the overall market sentiment a couple minutes ago. You've probably seen changes to the profit and loss chart, Mike, as well. So when those changes are done, the final change is to make things along those lines to make it easier. Now, another way you could do it, if your portfolio, Mike, is fairly large and you've got different expiration cycles, you can just choose to view positions that have an August expiration or something in September, for example. So only the couple of positions will come up on the near term. We also added, something in the next 9 days if you're trading weeklies in that case. So that will shorten up potentially your portfolio, Mike, so that you can see the headers more. But we'll get something that will have that column available to go to each position individually, or just to look a selection here for the more info to just look at this position individually, potentially. No ETA on that. I'll let you know when we get through the other projects as well. Robert asks, is this a good time to do radioactive trades? I believe so. I'm probably going to open a position next week. I was going to open one this week, but I could have had profits, but I didn't. I closed that HDS position, was looking to open a new one, but I was focusing more on some of the other strategies in my portfolio. And in that case, I believe Ernie didn't open a new one, but he made adjustments to all his. I also made adjustments on some of mine, Robert, as well this week as we started to see the sell warnings. We talked about Fabrinet and we talked about Kraft Heinz, which just paid a dividend yesterday, so it dropped a little bit when the market was going up. Here's the key. What are we talking about here? The radioactive trading approach. The married put approach done in the proper way to have long-term protection where at the worst case scenario, you can only lose 5 or 6%. What you're asking me, Robert, really, I think this relates to another question that's coming up after Octavio's, which is after yours, is with the market hitting these new peaks that we've been seeing and the sell warning being triggered in the market sentiment, do I want to enter a bullish position now? And my answer is yes. I don't mind it, and I'm going to do it. Why? Even if we're at the peak, even if this is the top of the market, or Monday, Robert, is the top of the market, and I open a married put, and the next 4 days, the correction starts, and 8 days later, we're down 7% across the market. That's not a recommendation or suggestion. Don't hold me to that. Okay, but let's say that happens. Where am I? I'm on a married put that probably has an expiration out to March and April, that probably originally had a 7 or 8% maximum risk on the position. Mine, would probably be around 7% max, 7.5% at the max. So right now, with the 5-7% pullback across the market, I'm probably only down 2 or 3%. And what do I have the ability to do if I think the market's going to recover after that correction? I can follow the rules in the blueprint to readjust the position, lower my cost basis, use that put as a second asset. Or I could open it with a ratio if I wanted to, that income method number 12, Robert, and then see how it plays out over the next 10 or 12 days to make an adjustment in that case. Also discussed in the blueprint. Worried about a downturn, but I want to leave the upside open. I've got the controlled risk in place, guaranteed. I could do an income method maybe right away as well. So if the market does fall, I would only do 6 in this case, but I do income method number 6. After opening the married put and the stock falls, the 6 works out perfect. I've reduced my risk a little bit. I can still readjust because that put is not just insurance. Remember, it's a second working asset in my favor. And of course, at times, if I start to see the return going down that direction, okay, if I start to see the markets going against me after I open a married put position, then hey, that's perfectly fine too. I've got ways to adjust it, ways to management. That's all in the blueprint. What are the ones I was considering? I was considering Newmont, but I think Ernie I thought was in one of these two, AEM or Newmont. So I'm considering one of those. SYY was very interesting. I did like the chart there. These were ones I opened this week. Ernie's in WPM. My apologies. That's the one he is in. DHI. I liked the chart earlier this week, but I tell you what, it's like the old girlfriend, right? You know, I traded DHI and had a minimal but reasonable profit on it a couple of years ago when I did that trade, when I traded that as a radioactive position for our Fusion subscribers at RadioActive Trading as well. I'm trying to avoid the pharmaceuticals right now until I do more. Medtronic is a little bit interesting also, but it's within my price range. That one is. PPG is just a little bit outside of it. And I don't know sale point. I'll be honest with you. For me right now, I think I like let me think here. Let me make my changes. Make my subtle changes here. So I'm going to go under 118, I believe, for now. And I'm going to put my risk under 7.5%. Let's call it 7.6, just in case there's 7.5. This is going to reduce the risk because there's a lot of high premiums out there. Interesting fact, we talked about it last week, is that when we were talking about the decay of a married put position, where the decay on the profit and loss chart was more than the customers asking the question thought it would be, is because it was inflated. The IVs on some of these bigger stocks out there, Newmont and so forth, the unknown of the November election, the unknown of the pandemic, the IVs further out in time are actually higher than the comparative near terms on the same stock. It's always something to keep in mind too. But if I've got the risk I want, the controlled, Newmont, I do kind of like this one. It's not too bad. It's a little bit more than 12% in the money. Buying the stock at 66.71, the March 75 put. We do not pay a dividend, I believe, but I'm not sure. 12.4% in the money with a risk of 7.3%. Fairly manageable. If this was a Wednesday webinar, I'd probably open this position after we ended the webinar. At midpoint, if I get it, it's only 6.9% instead of 7.3%. Okay, so I think this is a decent risk position. This matches my goals for the married put structure. Now, I'm not going to show an example of what I would do with a 12 or what I would do with a 6 right now, Robert, in that case. But yeah, that's what I'd be looking for right now using the default search. And again, there's always the opportunity that if you think the market's going to pull back, instead of doing a married call, I might just open a married put on an inverse ETF or 2 times inverse ETF as well. That's something that we talk about there at RadioActive Trading, and something that we can quickly do. Oh, Logitech, good one. Good risk. Ooh. You know what I'd want to look at? William just offers his thoughts. He said, I like LOGI for a married put trade. You know, I potentially might too, but I don't like this one. We're 17.6% in the money, 72.31 to 85 put for risk of 6.5%. I would love to see if there's an 82.5 or if there's bummer. I'd always like to see 82.5. I'd go with the 80 with the higher risk personally. I don't know. I think I would go with the 80 personally. I think the 85 is too deep in the money. I usually want to be under 15%. The rule is we never go above 20% in the money. Even though the risk is lower, the expectancy of profit also lowers dramatically as well. I think I'd be willing to take the higher risk here at 8.4% with a stock at 72 to go with the 80 put rather than go with the 85 at 6.5%. Different market conditions. Of course, at the same time, on all of my webinars, you've heard me say that usually for me, if it's in that range, usually it's the 3 bears, right? So just slightly in the money at 75, 9.3%, that's too high. 6.5 is really good, and that would usually be my target. 4.6 is too low. Either the 85 or the 80 is probably pretty good. But I'll take a look at that. I haven't studied it, but I hear what you're saying, William. I'm going to write it down. LOGI, March 80. I'm going to take that into consideration when I do my research this weekend or next week for what I might open. Might open 2 next week. We'll have to see. All right. Okay, so that's related to the married put for Robert. Those are the trades that I would do. I made some small adjustments based on my cost basis for my portfolio and what risk I like to take. Still have a good 10 positions. DHI is still in there again, just kind of lack of a better term. The old girlfriend's still flirting with me. Old girlfriends don't do that, but in any case. All right. Oh yeah, Workday was just like CRM today. Okay. Oh, and Sam adds a comment to this on the correction ideas. Sam says, look out for a correction. Have 30 to 40% cash available to do a killing in the downside. So Sam's holding cash aside to start playing the downside. Contra ETFs, as I mentioned, inverse ETFs, if he starts to see a drop. I am bought small. I didn't like the prices I was seeing in the VIX this week, Sam. So I did buy small shares, very, very small shares. I'm adding to it slowly as it continues to drop, but I did start buying UVXY. I bought, I think, 8 shares, and then I bought 4 shares, and then I might buy 10 shares when it pulled back. So I'm using UVXY right now as a placeholder instead of VIX calls or puts on SPY to hedge if I do open bull puts next week. All right, Octavio, as always, patient and always stays to the end for us. He says, I have been successfully trading ratio credit spreads, sell 3 calls, buy 1. Unfortunately, the monetary requirement is always high. Do you have any suggestions on how to reduce that margin requirement? The only way to reduce it is to buy more calls, Octavio. I'm sorry. You could do the stock, but I don't think you want to do that because you're playing the spreads. I don't know if you're doing a bull spread or if you're doing bear spreads. So if I guess you're doing a bull spread because you said 3. Let's just stick with now let's stick with Apple. We looked at that earlier. It's at 500. So let's no. Okay. I'll just go cheap 14 days out in time. So let's say I'm buying 1 490 and selling 3 505s. This is not a recommendation or suggestion. We're just looking at this for Octavio's needs. All right. So there we go. I'd get a net credit here of Friday, right? And this probably isn't as wide as you want to go, Octavio. I understand that. You're probably much further out of the money here for that kind of protection. There it is. All right, so we're getting 4,600 up front for a net credit of 2,340. Got a margin requirement of 98,000 in this case. Why? 2 short calls at 505 minus the credit we took in. Okay, max profit peak here at 505. This is not a recommendation. This is really risky. You see the break evens at 524. So it's about 5% up from where we are right now. Octavio, there's no way you can reduce margin by selling and collecting more premium. We had mentioned this a while back, I think, on another discussion that we had. The only way to take out the margin requirement is to buy more options. Okay, and you say, well, can I do some kind of, what if I did a bear call credit spread or a bull call debit spread, another bull call debit spread? Wouldn't that cancel the margin? No, because you're just still doing another short call linked to a long call. You haven't taken out the 2 short calls that are still naked. Buy shares of stock, that's one way to do it, but again, that's not what you want to do. You didn't want to put the monetary value in it. You're trading a spread position in that case. Okay, so is there some magic bull put spread or bull or put combination you can do? No, because buying a put or selling a put doesn't cover the obligation of a call, of a naked call position. Buying a put structure does not cover the obligation of the naked call. The only thing that covers the obligation of a naked call, reducing the margin, is buying another call or buying shares of stock. Okay, that's it. You could go out far. Anthony says you can buy 2 520 calls. Okay, you could. He's looking at his chain too. Oh, am I said 14 days out? Okay, so let's go. You could buy 2 520 calls. In this case, it costs you about $20, so you're going to end up with a small net credit. Essentially, you're kind of creating a butterfly, right, Anthony? Something very similar to it. It's broken wing butterfly in a sense, something along those lines. Small net credit of 285 now. You do still have a maximum profit of 1785. Lower the margin. But you gotta buy the calls, okay? Or the stock itself. Anthony, you're absolutely correct. We could get a lower cost by buying further out, but then we do have to cover that margin requirement between the strikes. As Anthony mentioned, what we're looking at now is we've got your 1-to-1 bull call spread with a 2-to-1 bear call spread, and you've got to cover the margin on that 20-point spread. Okay? It has to be done. That's the only way that you can do it. You could stagger the calls too. That comment just came in. So buy 1 520, as Anthony mentioned. Do sort of a laddering approach. Not something that I do or have tested, but go further out with a 540. Very wide spread, I understand. But now you've got it covered and you've got sort of a more broken butterfly, but it pushes the upper break even up a little bit more. Okay. Again, just in that case. All right. Okay, so you're absolutely right. You can convert this ratio into a butterfly broken wing butterfly, as you mentioned, Anthony, or a butterfly itself if you're worried about the market continuing to go up and the naked call side of that positions. Okay. Octavio said, I like buying SHIP option, a ship option. I don't know if you meant short, so a shorter term. So if I'm out to, if this ratio spread is actually out to October, if I'm buying a 1 week out call to hedge it, the one thing I don't like about that, collecting a premium that's far out in time, 35, 45 days out of time. Well, I like to collect premium any way I can get it. But the one thing I don't like about selling premium 35 to 40 days out in time and then buying extra protection week by week is that I'm going against one of the main caveats of options trading. And that's you always get a better annualized return when you sell shorter term, and you get a lower annualized cost when you buy further out in time. If I'm selling a December spread, a December 3-to-1 ratio right now, but I plan on buying extra calls in September and October and November and December to hedge the two calls that are naked, I'm going to have a higher annualized cost basis than if I just bought the 2 December calls right now to create the butterflies Anthony sort of pointed us in the direction to. Or Anthony did point it. I shouldn't say sort of. He did point us in the direction there as well. Okay. Kipp, I mean, okay. Let me go back to married puts for a moment here. I should have read this before, so I should have kept it in with the conversation from Robert. Kipp says, in a married put scenario, could you explore techniques for trade management, perhaps increasing exposure or scaling out of exposure as the trade develops? Well, that's what's discussed in the blueprint, in a sense, and I typically don't do that. I had a coaching session with Fernando. Was it 2 weeks ago, Fernando? It was the week after I came back from vacation, I believe, Fernando. And what we were talking about is the idea of taking a portfolio he has and then building essentially a new one, building a new married put portfolio. And should he jump in all at once or should he scale into the portfolio? And we feel it's a good idea to sort of scale in. So let's say, Kipp, I had $200,000 to start trading in married puts right now. Rather than open 5 positions on Monday, allocating $40,000 to each, I'd likely buy 1 position next week. And then 2 to 3 weeks later, buy another position. And then 2 to 3 weeks later, buy another position. So I'm gradually moving in, testing the markets as well. Now, as the stock moves up on my first position, Kipp, let's say we're 60 days in, and my stock has been moving up 5-7%. Well, I'm going to be doing the 12 income methods that are discussed in the blueprint rather than trying to make a profit by scaling up and scaling down the position. Okay, that's not what I want to do. I still want to keep diversified, and the money I've allocated to married puts in my portfolio, I want to use that allocated to, let's say, 7, 6, 8 positions. I don't want to just keep dumping money into a position. That being said, one of the things Fernando and I discussed is it's never a bad idea to keep the successful married puts he has in his current portfolio, sell out the ones that aren't performing as well to create capital to help go into those new positions as well. Okay, but I use the income method solely. I don't look into averaging down the married put. Rather than averaging down if the stock falls, I'm going to use that second asset. That's why the put is there. That's income method number 9. I'm going to use that to readjust the position or put myself in a better situation with a lower cost basis and a lower break even. And if the stock moves up, I'm going to use the ATM bell curve to manipulate the put and use the income generating income methods 1, 6, 5, 11, akin to a broken wing butterfly that we just talked about from Anthony's view as well. So I'm not looking to increasing exposure or scaling out of exposure as the trade develops. I'm using the put options to my benefit in those scenarios to lower the cost basis, bulletproof the position, generate income as well. Okay, all right. And Sam adds, it's a good idea to be simple in those situations, follow the simple rules, understand what you're doing, as opposed to keep adding back and forth. Okay, so, sorry. William says, Michael, do you find when the market sentiment indicator goes more bearish that there is less results for your bull put strategy? Absolutely. Also, the lowering of the VIX and the VXX that we talked about, William, is also taking the numbers out. Let me go back to power options. I'm sorry, William, I just didn't see that question, or you sent it right when I was wrapping up, but that's perfectly fine. Not wrapping up, but right when I linked back to the slides there. Awesome. Okay. So right now, VXX, as we talk, VIX is at 2296. Okay, we've got some earnings coming out still, so we know we're removing it from earnings. There's 22 total results. Now, does this mean this is happening because the market sentiment tool is going bearish and going into sell warnings? That's it. It's a correlation, but it's not direct. Why is the market sentiment tool going to sell warnings? Well, because SPX is extended, volatility is declining. Okay, other things, stocks above their 20-day, 50-day moving average, and so forth, are all still there, and we're in a little bit of an earnings season. Excuse me. So this isn't directly, less results aren't directly related to the market sentiment tool showing a bear sells. What it means is that because the market's been going up and those sell warnings have been triggered, that usually means the VIX is declining. When the VIX is lower, you see less results. An example, let's go back. Let's go back as far as I can go. We saw 22 results that matched the default bull put weekly spread. Let's go into the backtest Smart History Excel tool. Let's go back as far as I can go on our trial. That would be June 29th. And let's run our weekly bull puts. Okay, while we're waiting for that to come up, let's go back to the VIX. And see where the VIX was on June 29th. Where were we at? 30, 29, 31.78. Okay, so fairly big move. So here you go. Twice as many results. On that day, there were 40 total results that matched the criteria on June 29th, with VIX at 31.78. It's not a direct correlate, but yes, when volatility was higher, more positions would have an 85% probability could go the range out of the money and still give us that 12, 13, 14%, 17% average. That's really good time to trade. Actually, I had Spotify, not Shopify. Around this, I don't think it was June. Oh, it was beginning of June. I did Spotify, not Shopify, if I remember correctly. I was just looking at them. I don't see any of the other ones I did here. So I wouldn't have opened on June 29th, I don't think. I don't think that was the trade date. But in any case, that, William, is what we're talking about there. Because the VIX is declining. It's still relatively high for what we were used to 2 years ago, right? When the VIX would just hover around 12, 13, and 14. Here we are at 22, almost 50% higher than we normally expect to see it. Right, 22.96. Okay, I'll call it 23 in that case. So yeah, that's a good example there. But it's because as VIX is declining, as the market is still going up, it's not so much related directly to the market sentiment tool. It's related to the components of the market sentiment tool, which would also relate to why many stocks aren't showing the credit we want with the probability we want, as many as were showing up in April, May, and June, as we saw. Okay, almost double. That's an interesting thought. Sam adds another comment. He says, today, airline stocks and energy oil stocks were up, but the XLE daily energy ETF is bearish. Oil might pull the market down. Hey, something's got to start it if it does start to pull down. And, that's been bouncing around for a while. I don't want to say bouncing around. I'm sorry. I don't want to say bouncing around there. I'm sorry, you guys, did I not show that? The Smart History Excel there, that was the 40 results there from June 29th. My apologies if I didn't show that before. And the current search for the Bull Put Weekly is just at 22, with the VIX hovering around $23 per share. We've got 22. Helps if I go on the right screen, doesn't it? That's an interesting point, though, William, because even though when volatility was higher, and you'd think that the risk for the far out married puts would be above that 7.5%, 8% we like to look at. There's my 22 results. The results of the married put default search have also declined significantly in the last couple of months. So where we're seeing 20 and 22 results, and back in April and May, I was probably seeing 40, 45, 50 married puts that matched the default radioactive criteria, even though volatility was higher. But that was the thing. Volatility was high then, but the volatility when you were looking at puts at that time, at October and September, like where my Fabrinet position was and the HDS position was when I opened those in April, the volatility was lower. Now looking out to March and to April, the volatility is higher because of the unexpected of how things are going to go and that tricky little thing in November, that little election that's going to have an effect one way or the other, or no effect and surprise us all. Who knows, right? All right. So in any case, that's what we're kind of seeing with those different screens. That's why they're kind of changing, is because the market's changing. It's not directly a correlation to the market sentiment, but the components of the market sentiment do correlate as to why you're seeing less results in the bull put credit spread screen and the married put screen to what we were seeing several months ago. 4 months ago. Feels like 10, but 3 or 4 months ago. All right. Well, ladies and gentlemen, I want to thank you for joining me today. I want to thank you for all your comments, your help with the discussions, and of course your commentary to help Fernando and myself with that little presentation we're doing. It'll all be included in there. But I just want to remind everyone that today's material are my thoughts and your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading recommendations or suggestions. Options do involve risk and may not be suitable for all investors, but hopefully with my help, they will be suitable for you going forward. If you haven't yet, and you like some of the tools you saw today, that long option finder tool, we did a couple of search criterias for the married puts, and we looked at the bull put credit spread as well. We walked through some of the what if scenarios, but if you haven't tested out Power Options yet, remember you can do so at any time. Just go to PowerOp.com, put in your name and email address. You'll have full access for a 14-day free trial, no credit card or billing information required. After that, the subscription levels, monthly subscription levels start at only $45 per month. Of course, we do offer upgrades if you want a delayed service, access to the historical tools, which goes back several years, not just the 2 months I showed you on the trial account, but you'll get a taste of that on your trial. And then, of course, we do offer a real-time service and the whole kit and caboodle, the premium service as well. Well, as we didn't mention it today, but as mentioned, a lot of the discussion and a lot of education is available in the webinars. That is a public page. You can see most of the webinars. Some of the webinars are only available to Power Options subscribers, but if you go to powerop.com/webinars.asp, you'll still have about 50, 60 webinars in each of the 4 categories that you can view. Well, I should say probably 100 total, but you'll be missing some as a non-subscriber, but it is a public page. You can also check out our YouTube channel where most of our videos are posted for public as well. Of course, we've got the blog there at blog.poweropt.com. I spent so much time trying to finish up those slides for Tiny Pirate there. I did it again. I forgot to edit this from 2 weeks ago. So yes, there will be a webinar next week on September 4th, I believe it's going to be. Yes, that's correct. September 4th, there will be a Friday presentation because the market doesn't close early, but the next Monday, the 7th, is closed due to Labor Day weekend. But there will be a webinar next week. If you think of any questions over the weekend, send me an email at any time to support@powerop.com and support@radioactivetrading.com, either or. Also call us during market hours at 302-992-7971. Of course, remember, trial members and subscribers can schedule a coaching session at any time. That's essentially a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools in the site and answer any questions that you have. Okay, so I posted most of the videos for last week. What's missing is John's question about the naked put picks of the day that we reviewed from last week. Mike E's other comment on setting up the columns. Rex having us go through the bull put credit spread search and what happens when a bull put vertical goes in the money for both Ron and for Lawrence. That webinar has been crashing every time I try to produce it. So I'm going to have to re-grab that section, those different sections, and put them together in a cleaner text that's not corrupted. That's the only webinar that's still missing. It's about 21 minutes long, and we'll start getting these segments together. The first segment for our YouTube viewers, for Tiny Pirate and for PK, that'll be one section. It'll probably be real quick to crop. I'll have that probably up tomorrow as well. And then we'll start going through our other sections from this evening presentation, and you'll get an email when those webinars are posted. All right, so Kipp says, great presentation. Thank you, Michael. Have a great weekend. Thank you, Kipp. Thank you for your questions and joining us today. You have a fantastic weekend also. William says, great session, Michael. Have fun with the 3- and 6-year-olds this weekend. Well, I'll do my best, William. Of course, we all have, I'm sure we all have work to do around the house in addition to having fun, but I hope you have a great weekend as well. And Sam says, thank you, sir. Have a good, relaxing weekend. Enjoy the evening. I'm going to try to. I think I'm going to go with a little bit of wine tonight. And WPR is rocketing up after market, so keep an eye on it. I will do so, Sam. WPR I'm not familiar with, but I'll take a look at that. Might even use it as a married put. We'll see what happens on Monday when I start opening a couple new positions. I'm sorry, VVPR. Wow. VVPR. Let me jot that down, correct my notes here. VVPR. All right. All right. Excellent. Ladies and gentlemen, thank you once again. Have a fantastic weekend. Stay safe. Stay healthy. We will see you soon. Good night.